every investment proposals, every investment project will have certain degree of risk that is associated. So that risk has to be adjusted in order to find out what is the cash flow. So depending upon the type of investment, depending upon the company, the risk will be associated. Net cash flow into probability will be given into probability. The summation of that, the total of that will be your expected net cash flow. Hello everybody, I'm Divya, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. I take this opportunity to welcome you all for the session 1 on your Unit 2, Risk Analysis in Capital Budgeting. The topic for today's discussion, risk analysis and capital budgeting, introduction to risk analysis and capital budgeting, risk and uncertainty, the terminology, what is risk and what is uncertainty and what is the difference between risk and uncertainty, sources of risk, techniques of risk analysis in capital budgeting, that is your statistical technique. In statistical technique, we have various different techniques. In that, you'll be calculating expected net cash flows and expected net present value. So in the last class, we have successfully completed your Unit 1, that is your cost of capital and the capital structure theories. So without wasting much of our time, so let us start discussing about your Unit 2. So risk analysis was put into your capital budgeting. So in the previous semester, you people have learned about capital budgeting techniques. So how do you get NPV? You are familiar with NPV, your ARR, IRR. So all these are the different techniques that is there, and you used to calculate the net present value. So here you will see only the risk analysis that is associated in the capital budgeting. So capital budgeting is all about investment decision. So today if you are investing, and what is the return that you will be getting after so many years? What is the risk that is associated with that? So all those things, and how can we analyze the risk? Risk is nothing but uncertainty or the loss that will be there. Suppose you have an investment of 3 lakh rupees with you people, and you have 2 projects to invest, project A and project B. So you'll invest those 3 lakh amount. So what will be the cash flow? What will be the return that is there? Project A, you'll get return after so many years, 2 lakh rupees, and project B, you'll get your 1 lakh rupees. So what is this 2 lakh and 1 lakh? It is nothing but the loss. So risk is nothing but whatever the return you're expecting, that might vary. The loss that you incur is called as risk. So that analysis, the detailed study of risk. So risk management is very important. Risk adjustment is very important. So when you adjust the risk and calculate the cash flow on an approximate basis, you will get to know, you can predict the cash flows. What is the cash that you will be getting? What is the return that you will be getting? So in this chapter, you will be discussing about, you will be able to know about what is risk is all about and what are the different techniques are there in order to analyze the risk, in order to know in what technique that you can make sure the risk can be measured and adjusted so that the value can be predicted. So if you know the cash flows, and by the assigning of probability, you can know what is the return. But when you doesn't know what is the cash flow, and when you doesn't know anything, you cannot assign the probability. So that is called as uncertainty. So future is always unexpected. We cannot predict aptly. So in the capital budgeting, you have learned about the various techniques about different capital budgeting. So that is your modern technique as well as traditional techniques. So in this semester, they have put you the syllabus, that is your risk analysis in capital budgeting, because to analyze the risk and to know what technique can be predicted, how can you understand risk. So that is why risk analysis is there in your syllabus. Moving forward, forward, so let us understand what is risk analysis is all about. What is risk? There is a slight difference between risk and uncertainty. So let us look into the further slide and understand what is risk is all about, what is uncertainty is all about. So let us understand what is your introduction part. So while discussing the capital budgeting technique, we have assumed that investment proposal do not have any risk. So cash flows of the project will be known to us certainly, but in real scenario, in your real situation, there will be an uncertainty in predicting the cash flows. So that is called as risk. This assumption was taken to simply make you all understand about the concept of capital budgeting. But however, in practice, the assumption is not correct. In fact, every investment proposals, every investment project will have certain degree of risk that is associated. So that risk has to be adjusted in order to find out what is the cash flow. So there are three types of decision making when it comes to investment proposal, investment decision. Three types of decision will be taken because with every investment there will be risk associated. So 3 lakh if you are investing today, you should get 3,50,000 because for an higher return only everybody will invest in certain project. But you doesn't know what will be the profit, what will be the return in the next upcoming days due to the various factors, due to various risks. So 3 lakh investment, in that you will get only 2 lakhs. So the difference amount what you will be having, that is loss. So loss is what? Here it is a risk for an organization, for a firm, because once the investment is done, it cannot be revert back. Once the money is put into, it cannot get back easily. So the return should come on a yearly basis. So that is why risk analysis is important. So decision making under certainty. So when the cash flows are certain, so they will take decisions with certainty. When the cash flows involve risk, so the probability will be assigned. So what is probability? The chance of an occurrence. So if you have a probability, if you know that if you are certain with the cash flow, the probability will be 1. If you are uncertain with the cash flows, the probability will be 0. So if you assign 0 probability or if you get 0 probability, it means that you doesn't know the certainty of the cash flow. So what return that you will be getting. So first decision is decision regarding with respect to your uncertainty. With respect to your certainty, decision making involves risk. When you have risk, that is sure that there is a uncertain in the cash flow. So by assigning the probabilities, probability is nothing but chance of an occurrence. So by assigning a probability, so you will be able to figure out the information when you have certain information about the cash flow. But when you doesn't have any information or the cash flow is uncertain, you doesn't know, you cannot predict anything, then it is that situation is called as what? Uncertainty. So decision making under uncertainty. So the firm will face 3 situations. First is decision with respect to certainty, decision with respect to risk associated with that, and decision making under uncertainty. So when the cash flows are uncertain, probability cannot be assigned. So such a situation is called as uncertain. Moving forward, so what is risk is all about? I have already explained you people the risk and the uncertain. So uncertainty, risk is the variability in terms of actual return comparing with the expected return. So 3 lakh if you are investing, 3,50,000 you are expecting, but you get what? 2 lakh. What is that? That is risk. Most common technique of risk measurement, usually risk can be measured using your statistical techniques, that is your standard deviation, variation and coefficient. So we have also the other techniques to calculate the risk analysis. So let us look at all those things in one by one in your upcoming slides. So there is a thin difference between risk and uncertainty. So there is a difference in risk and uncertainty. As I have told you, risk is nothing but the difference in the return, what you get, the loss. Uncertainty is nothing but sometimes if your cash flow is certain, so what you do, you assign the probabilities. Probability 0.1, probability 0.10. The chance of getting your return 1%, 20%, 30%, and then you assign the probability and you get your cash flow, expected net cash flows. But you doesn't know any information about the cash flow. When the cash flow itself is uncertain to you people, it is not known to you people, such a situation is uncertainty. So when no information is known to formulate probability distribution, when no information is available with respect to the cash flows, probability distribution cannot be done. So in such a situation, what the organization will do, they will think that the cash flow is not certain, so they will treat that as uncertainty. So however, these two terms are used interchangeably. So this is very important to know, because risk is different, uncertainty is different. So risk is nothing but the loss. Uncertainty, you have no information with you with respect to your cash flow. So probability distribution becomes difficult. Moving forward, so before this, let us understand what are the different techniques that we have in risk analysis in capital budgeting. So why I have put that in the first slide is because it is very important for you all to know what is risk technique, why it is there. So what are the different techniques we have? The first is statistical technique, conventional technique, and the other techniques. So these two, statistical technique and conventional techniques, is important for your examination. It is practical oriented. So this is theory oriented and these two are practical oriented. So you have to solve the problem based on these two. So this risk analysis is your CA intermediate syllabus. So they have put you, UOM, University of Mysuru, have put this syllabus for you people so that you prepare yourself for the CA right now. So FM, as I have told you, if you study here in your graduation level, so it will be helpful for your post-graduation, your CA, CS, CMA, and it is a core mandatory subject, FM, financial management. So this risk analysis is newly adopted for you people so that you prepare yourself for CA. So statistical technique, probability, variance or standard deviation, coefficient of variation. So statistics means numbers. So where you have to calculate by assigning certain probabilities and your formula of variation and standard deviation and coefficient of variation, you will be solving the problem. So statistical technique is the first technique in your risk analysis and capital budgeting. Moving forward, the second technique is risk adjusted discount rate. In that we have another technique, that is certainty equivalent approach. So this is also very important for your examination. So the theory part is sensitivity analysis and scenario analysis. So there is also the problem, but for your syllabus they have limited to your theory part itself. So let us understand the theory part of sensitivity analysis and scenario analysis in our upcoming sessions. Moving forward, sources of risk. So from what are the risks that is there for the company, from where risk arises, from what is the base for the risk. So let us look it into one by one. Risk arises from different sources depending upon the type of investment. So depending upon the type of investment, depending upon the company, the risk will be associated. So being considered as well as the circumstances, the industry in which the organization is operating, some of the sources of risk are as follows. The first risk is project specific risk. So based on the project what you take, risk arises. What are the risks? Risks which are related to a particular project and affect the project cash flow. It includes completion of project schedule time. So based on that project, number of years to complete that particular project, what time it takes. So based on that, risk arises. So there will be error of estimation in resources. So while estimating the resources, there might be the error, allocation, estimation of cash flow. We have one examples. So a nuclear power project of a company, generation company, has different risks than idle project. So depending upon the project, so we have nuclear power project and idle power projects. So the project might vary because the completion of the time, the resource allocation, depending upon the project, will be having project specific risk. Moving forward, company specific risk which arise due to company specific factors like downgrading of credit rating, chances in key managerial persons. So changes in key managerial persons. So main persons will be there, the top executive, the change of them because they make the strategy. If they are not there, the changes will affect the company. So cases of violation of intellectual property rights and other laws, rules and regulation with respect to the company, so there will be risk associated. So for example, two banks have different exposure to default risk. Next, we have industry specific risk. Depending upon the industry's risk arises. What are the risks that arises? Regulatory restrictions on industry, change in technologies. So when you change the technologies, the entire process itself will change. We doesn't know what is the output. When we doesn't know what is the output, it will be very difficult for us to fix the prices, to know what quality to be maintained. So for example, regulatory restrictions imposed on leather and breweries industries. So if certain regulations are imposed on all of a sudden, the return are unexpected. So market risk, the risk arises due to market related conditions. So entry of substitute. So you have this pen with you. So again, if you have another pen, what you do which is more fancy, you people buy that pen. So what will be the effect on the other company? So the price of the product will come down, the sales will come down. So it will adversely affect the competition in the particular market. So change in the demand condition. Suddenly there will be change in tomato, so all people will not sell the tomato and all of a sudden the demand declines, so the tomato will spoil and there will be loss. So demand situation will happen in the particular market. Availability and access core sources. For example, a thermal power project get affected if the coal mines are unavailable, so unable to supply coal requirement of a thermal power company. So they have thermal power projects, so get affected if the coal mines are unable to supply the coal. So how they can manufacture raw materials? If they doesn't supply the proper raw materials at a right time, at a right place, the production will stop. So this is what we have market risk. The next risk we have is competition risk. Competition is very important to have a healthy and a safe competition in the particular market. So if you have monopoly in the market, so it will lead to what? It will lead to a poor economic conditions. So these are risks related with competition in the market in which a company operates. These risks are risk of entity, rival, products, dynamics, change in the taste and preferences of the customer. So these are the different sources of risk, that is competition risk. So moving forward, the last two risks that we have is risk due to economic conditions. So economic, which is related to fiscal policy, which is related to your RBI, the bank policy, the monetary policy. So all this, if there is certain changes in that, in the tax rate, that will affect the organization, that will affect the firm. Moving forward, we have international risk. So these are the risks which is related with the condition which is caused by global economic condition like restriction on trade. So there will be no free trade that is available. If they impose certain restriction, the trade barriers, tariff barriers, non-tariff barriers, then it will be sudden effect on the company's product, company's performance. Restrictions on market access. Suppose they put a restrictions on a market access. Now all the abroad companies, they are outsourcing our Indian laborers for their work. For example, the medical billing work. So if that outsourcing stops, then it will be difficult for them. If they impose the restriction to the access of the particular market, then it will be difficult. So what for the cotton and for other things, they rely on the our Indian market. So if they restrict that, it will be very difficult. Market access, bilateral agreement, political and geographical condition, etc. We have an example here. Restrictions on outsourcing of jobs to overseas market. As I have told you, if they impose the restrictions of jobs for an overseas market, then it will be, for an international markets, then it will be difficult. So all these are the different types of risk that is associated, and the sources of risk, from where risk arises. What condition which will impact, which will affect the risk, what are the factors which are contributing for the risk to the company. Moving forward, this technique we have already discussed. The first technique we have is probability. So let us discuss probability and the problems on probabilities in today's class. Probability is nothing but the chance of an occurrence of an event, the chance of an occurrence of an event. So probability, if you have the certainty of cash flow, if you know the cash flow, then certainty is there, assign the probability. So this might be the cash flow that you incur, so it will be, probability will be 1. So if the cash flows are uncertain and if you cannot predict the cash flows, then it will be 0, probability 0. So in probability calculation, you need to calculate two problems. One is you have to calculate expected net cash flows. What is the first thing you need to calculate? The first thing you need to calculate under your probability is expected net cash flow. Expected net cash flow. And the other thing you need to calculate is what? You need to calculate expected net present value. So what you need to calculate in your probability? Expected net present value. So these are the two things that you will be calculating and will be solving the first technique, statistical technique. In that we are solving probability problem. So I have explained what is probability and expected net cash flow and expected net present value. So expected net cash flow, how do you calculate? You will calculate by cash flows into probability, net cash flows into probability. The summation of this will be your expected net cash flow. So how do you calculate your expected net cash flow? So cash flow will be given in the question, that is your net cash flow will be given. So net cash flow into probability will be given, into probability. The summation of that, the total of that will be your expected net cash flow. And you have one more thing, expected net present value. So expected net present value you have to calculate for the single period as well as multiple period. So in the further slide, I will explain that. Moving forward, so on the probability, let us take up one example. So we have assumption, best guess, high guess, low guess, cash flows are given, probability is given. So what is the cash flow? 3 lakh, 2 lakh, 1 lakh, probability 0.3. So 3%, that is your 30% is the cash flow, expected cash flow that you will be getting 3 lakh. So 60%, that is your probability that you know that your amount will be, you will get the cash flow as 2 lakh. So 10% will be the expected cash flow that you will be getting for the low guess, that is 1 lakh. So if you do multiplication and summarize the value, you will get the expected net cash flow. We have a formula here. So how to get the formula? So expected net cash flow into probability. If you do it, the summation of this is expected net cash flow. Best guess, high guess, low guess, 3 lakh, 2 lakh and 1 lakh. The probability that is assigned is 30%, 60% and 10%. That if you multiply, you will get 90,000 and you'll be getting how much? You'll be getting 1,20,000 and 12,000. The total of it is expected net cash flow. So how do you get that? 3 lakh into probability. The total of it is 2,22,000. So what is that? Your expected net cash flow. So for further calculation of your standard deviation, variance and the coefficient of variation, you need to calculate this expected net cash flow. So then only you can calculate the further thing. Moving forward, expected net present value, as I have told you, you need to calculate that. So as I have told you, expected net cash flow you will be calculating for a single period as well as for the multiple period. Single period 1 year will be there, multiple period more than 1 year will be there. So we have PV factor here. So the discount rate will be given in the question. So that discount rate you have to check in your PV factor table. So that PV factor table I will display in the next class. So what is the formula for that? Sum of present value of expected net cash flows into your probability minus initial investment or the initial cost. That is the formula. So what does this E and PV stands for? Expected net present value. So what is this T stands for? That is in period. What is this K stands for? It is nothing but the discount rate. So while taking up the problem in the next class, we'll discuss in detail. So how to solve your expected net present value, your expected net cash flow will be given. Expected net cash flow into probability. So minus your initial cost or initial investment, you will get your expected net present value. So that has to be calculated for the single period as well as multiple period. So discount rate is given. So you need to calculate your PV factor. So PV factor 10% for 1 year, how much it is? So we need to calculate that. So that's it for today's class. Hope the class was interesting, fruitful. So keep smiling people. Smile is the biggest jewel you can wear. Keep smiling. Thank you.